12%. I mean, just look at that number. In a market like today's, that really grabs your attention, right? It's promising this huge, massive income stream. But here's the kicker. It's not from your typical dividends, not from bonds. So what in the world is it?
And that, right there, is the big question we're going to dig into. Is this 12% yield some kind of clever financial innovation? Or is it just another one of those yield traps in disguise? We are going to pull this thing apart and figure it out together. All right, so the subject of our deep dive today is the Roundhill BIG Income ETF. The ticker is BIGY, or BIGY. And this fund has been making a lot of waves, getting a ton of attention, and it's really all for one big reason, that juicy 12% distribution target.
Okay, so let's get right into it. To really get a handle on Big Y, we've got to first talk about why a 12% yield is so alluring. I mean, think about it. If you're a retiree or just an investor looking for income, or frankly, if you're just sick and tired of tiny interest rates, a consistent, high payout like this, it's pretty much the holy grail.
So, what is this thing really? Well, Big EYG is not your average run-of-the-mill fund. Nope, it's an actively managed ETF, and its whole game is using option strategies on big, well-known stocks to churn out income. You can almost think of it like a cash flow machine, one that's built to take market ups and downs, that volatility, and literally turn it into cold, hard cash in your pocket every month.
But how does the machine actually work? How does it conjure up a 12% income stream seemingly out of nowhere? Well, the answer is in its engine room, which runs on two core option strategies. Let's pop the hood and take a look.
So the first part of the engine is something called a covered call. The easiest way to think about this is like you're renting out your stocks. So the fund owns a stock, let's just say it's Apple, and then it sells someone else the right to buy that stock from them later at a higher price. And just for selling that right, Big Y gets paid a fee right up front. That fee is called a premium.
Okay, so here's how that actually looks in practice. Step 1, the fund buys a stock. Then, step 2, it sells that call option. What it's really doing is selling off the potential for huge future gains. In exchange, it gets cash, that premium, in its pocket, immediately. Now, there's a trade-off, and it's a big one. If that stock goes to the moon, the fund misses out on that huge write-up. But no matter what happens, that cash premium they collected at the beginning, that's theirs to keep.
All right, so the other side of this income engine is called the cash-secured put. With this one, the fund is basically getting paid to make a promise to buy a stock, but only if the price drops. I love this analogy. It's kind of like making a lowball offer on a house, and the seller pays you a fee just for making the offer in the first place.
Let's break that down. The fund says, hey, I'll agree to buy this stock from you, but only if the price falls to this lower level. And just for making that promise, boom, they get paid a cash premium. Now, if the stock's price never drops that low, awesome. They just keep the cash, no strings attached. But if the price does drop, well, then they have to buy the stock. But hey, they get it at that cheaper, discounted price they wanted all along. And they still get to keep the premium they were paid at the start. See how that works? Okay, now we're getting to the really, really important part of this whole thing. Because that 12% yield, I mean, it sounds amazing, right? But you and I both know nothing in the world of investing is ever truly free. There are always trade-offs, and it is absolutely crucial that we understand what they are.
And here it is, the big one. This is the fundamental trade-off of a fund like this. By selling those call options to get that immediate income, you are putting a ceiling on your potential gains. You are giving up the chance to hit a home run if the market has a massive rally. And at the exact same time, you have zero protection on the downside. If the market tanks, this fund is going right down with it.
And the risks don't stop there. There are a few others you got to know about. First up is NAV erosion. This is a huge one. It's the risk that the fund is just paying you back your own money to hit that 12% number, causing the fund's actual value to shrink over time. Then there's the fact that this whole strategy depends on volatility. If the market gets real calm and boring, those option premiums can dry up, and that juicy yield could shrink. And last but not least, taxes.
Yeah, this is a point people so often forget. The kind of income this fund generates, it's usually taxed as short-term capital gains. And that tax rate is way, way higher than the rate for qualified dividends. So what does that mean for you? It means that 12% yield could look a lot smaller after Uncle Sam takes his piece. It's why a fund like Big Y is probably a much better fit inside a tax-sheltered account, like an IRA, where you don't have to worry about that tax hit.
All right, so let's put all the pieces together. We've got the mechanics of how it works, and we've got the risks. Now we can start to figure out the big picture. Where does a fund like Big Y actually belong in a portfolio? And maybe more importantly,
who is this thing really for?
You know, it really helps to see how BIGY stacks up against its competitors. When you put it side by side with other income ETFs, its personality really comes out. It's definitely more aggressive than, say, the super popular JEPI because it's shooting for a way higher yield. Its yield target is kind of in the same ballpark as QYLD, but it's much more actively managed. All this puts it in a totally different risk category than a more conservative fund like Devo. It's really carved out its own unique, aggressive spot in the market.
So, who is the ideal person for this fund? Well, it's probably a good fit for someone who is laser-focused on generating cash flow right now, someone who gets how options work, and like we said, is probably holding this in a tax-sheltered account. Now, who should stay away? Pretty much any investor who's focused on growth, for one. Also, anyone who can't stomach seeing their account value bounce around a lot. And for sure, it's not for anyone out there who thinks a 12% yield is some kind of free lunch with no risks attached.
This is so important to get. You have to understand the kind of weather this fund is built for. If the market is a roaring bull, just charging ahead, BIGY is going to get left in the dust because its upside is capped. If the market has a sudden, sharp crash, it's going to get hammered. But what's its sweet spot? Where does it really shine? A boring, choppy, sideways market. That's its home turf. That's where it can just sit back and collect those option premiums while everyone else is going nowhere.
You know, at the end of the day, this whole thing really just comes back to one of the oldest, truest rules in all of investing. There is no such thing as a free lunch. That 12% payout is real, it's tempting, and yeah, it's achievable, but it is attached at the hip to some very real risks. Risks that you just can't afford to ignore. So what's the final verdict here? Well, BIGY probably shouldn't be the core, the center of your portfolio. It's much better suited as a smaller satellite position, maybe a 5 or 10% slice of the pie to add a different kind of income stream. But betting the whole farm on a strategy like this, that is probably asking for trouble down the line. And that really leaves us with the one big question that you have to ask yourself. Is that steady, predictable cash flow every month? Is that worth more to you than the chance for bigger, long-term growth? There's no right or wrong answer here. It's different for every single person. But figuring out that answer is the key to knowing if a fund like BIGY really has a place in your own financial plan.